Hi, my name is Ujat and welcome to Rock with Option, a show for all your option needs. In this series, we're going to do something a little different. We are not going to talk about strategies, but we're going to talk about fundamentals. Have you bought a call option expecting the market to move in a positive direction? And when the market actually moved in the positive direction, say 5 to 10 days later, um, and your call option is giving you negative returns, if you've encountered such scenarios, you have ended at the right place. In this series, we're going to talk about all the parameters, all the metrics that influence option pricing. Each of these parameters is denoted by a Greek symbol: delta, gamma, vega, theta, and rho. We're going to do a deep dive on each of these parameters and see its influence on option pricing. As option traders, it's very critical that you understand both practically and theoretically the impact of each of these Greeks on option pricing. A better understanding will surely ensure your win rate and your profitability is considerably improved. Again, the Greeks, these are parameters that impact option pricing. There are 5 of them: delta, gamma, vega, theta, and rho. In the first few videos, we're going to evaluate each of these Greeks and talk about their influence on option pricings. We're going to evaluate each of them independently. Then subsequently, we're going to bring all of these parameters together and see what is the combined effect that these Greeks has on option pricing. So the first few series is going to be more theoretical. It gives you a theoretical understanding of each of these Greeks and what influence it has. Then once we bring all of these Greeks together, it can help us understand practically the various different elements that influence option pricing, and that will help us strategize our option trades. So we're going to kickstart our series on Greeks with delta. Delta is the most fundamental and one of the most important Greeks that influence option pricing, which is directly connected to the underlying. So we're going to talk about what is delta, what influence it has on the option pricing, and how we can take advantage of delta in our trades. So what is delta? Delta, simply put, is the rate of change of option price given 1 rupee increase or decrease in the price of the underlying. So basically, delta connects the option price and the price of the underlying. Take for example Nifty option. So delta captures what impact a 1 rupee increase or decrease in Nifty has on the option price. Deltas can range anywhere between -1 to 1, and different options have different deltas. Now let's look at some of the examples to get a better understanding of delta. Let's consider a called option trading at 10 rupees and has a delta of 0.75. So if there's 1 rupee increase in the underlying, the call option increases by 75 paisa and the new price would be 10.75. The inverse is also true. If there's a 1 rupee drop in the underlying, when the underlying drops by 1 rupee, the call option price drops by 75 paisa and will trade at 9.25. Let's look at another example. If you consider a call option with trading at 50 rupees and has a delta of 0.5, for every 1 rupee increase or 1 rupee decrease in the underlying, the call option will increase by 50 paisa or decrease by 50 paisa respectively. Now let's look at the put option. A put option with a option which is trading at 25 rupees has a negative delta of 0.25. This means that with every 1 rupee increase in the underlying, the put option price drops by 25 paisa and trades at 24.75. If the underlying price decreases by 1 rupee, the put option price increases by 25 paisa and will trade at 25.25. Now let's consider deep in the money put option, which usually has a delta very close to -1. In this case, if there's a 1 rupee increase in the underlying, the put price drops by 1 rupee. If there's a 1 rupee decrease in the underlying, put price increases by 1 rupee and trades at 11 rupees. So in a sense, delta captures the impact of the underlying price on the option price. Now let's look at the delta range and compare the call deltas with that of the put deltas. As we discussed earlier, delta ranges from -1 to +1. Now let us look at a long put option. When does one buy a put option? When you're bearish of the underlying. That means that when the price of the underlying drops, the put option price increases. And when the price of the underlying increases, the put option price decreases. There's an inverse relationship between the price of the put option and the price of the underlying. It is for this reason the put option has a negative delta and ranges from -0.1 to 0. The at the money call put option has a delta of -0.5. That means for every 1 rupee drop in the underlying, the put option premium increases by 50 paisa. The inverse is true as well. So for every 1 rupee increase in the underlying, the put option price decreases by 50 paisa. The delta of in the money put option ranges from -1 to -0.5, and delta of out of the money put option ranges from -0.5 to 0. Now let us look at the call option. When does one buy a call option? When you're bullish on the underlying. That means when the underlying moves in the positive direction, the call option prices increases. When the underlying price decreases, call option price decreases. So there is a positive relationship between the price of the call option and price of the underlying. It is for this reason the delta of a call option is positive and ranges from 0 to +1. The at the money call option has a delta of +0.5. That means that for every 1 rupee increase in the underlying, the call option price increases by 50 paisa. And for every 1 rupee decrease in the underlying, the call option price decreases by 0.5. The out of the money call option ranges from 0 to +0.5, and in the money call option delta ranges from +0.5 to 1. Now that we have understood the relationship between long put option, long call option with delta, now let us look at what is the delta for short call option and short put option. As you are aware, a short call option behaves very similar to a long put option. So hence a short call option has a negative delta and ranges from -1 to 0. A short put option mimics or behaves similar to a long call option, so hence has a positive delta range and ranges from 0 to +1. This is one infographic that you would want to remember for a long time, because all of the option strategies is based on this relationship between call option, put option and delta. So from this learning so far, we can conclude that delta helps us assess or analyze our directional risk. So if I say I have positive deltas on my trade, that means that I expect the underlying or the market to move in the positive direction. So I'm bullish on the underlying. Take for instance selling a put option. As we have seen in the previous slide, shorting a put option gives us positive deltas. That means I make money on this particular option trade only when the market moves higher. If the market moves lower or if the underlying falls, I start seeing losses on my option trade. Similarly, if I say I have negative delta, that means I'm short on the market or the underlying, and I make money only when the market or the underlying falls. I can also have delta neutral strategies. For instance, short triangle or a short straddle. Here in a short triangle scenario, I'll be selling a call option and the put option simultaneously, and the deltas of these options cancel each other, giving a net delta of 0. In this case, even if the market moves in the positive or negative direction, it has very little impact on the underlying. The other thing to note is higher the absolute value of delta, higher is the directional risk. So for instance, if I buy deep in the money put option, which has a delta of -1, in this case, for every 1 rupee increase in the underlying, I lose 1 rupee on the option. This has a higher directional risk than a put option, out of the money put option with a delta of minus 0.3. So in conclusion, delta not only gives us the directional risk, but also helps us get an understanding of the extent of that directional risk. Delta also gives us the probability of an option trade expiring in the money. This can be obtained by multiplying the absolute value of option delta with by 100. Now let's look at a few examples to understand this concept better. As discussed earlier, at the money call option has a positive 0.5 delta, at the money put option has a negative 0.5 delta. So the underlying in each of these cases, there's a 50% chance the underlying can move in the positive, there's a 50% chance the underlying could move in the negative. So at the money call option and at the money put option has a 50% probability of expiring in the money. If you take an instance of in the money call option has a delta of 0.8, so since it's already in the money, the chances of the probability of it expiring in the money is higher. So you will see, so hence in this case the probability is 80%. So the deeper the call option or the deeper in the money the put option, higher is the probability of that option expiring in the money. If you look at out of the money call option or out of the money put option, the underlying has to either move significantly in the positive for call option, or in case of put option, the underlying has to move significantly downward for the option trades to expire in the money. So the probability of out of money call option, out of the money put option expiring in the money is lower. In this example, it is around 20%. Now, having learned the basics of delta, let's look at how we can use delta in our trading. As we've learned in the previous slide, at the money options have a 0.5 delta and the probability of these options ending in the money is 50%. At lower strike prices, the call options are in the money to start off with, so they have a higher probability to remain in the money. So the delta is also more than 0.5. For put options, these put options are out of the money at lower strike prices, so the probability of that they will become in the money at expiry is less than 50%. For higher strike prices, the inverse is true. The call options are out of the money, so the probability of them ending up in the money is less than 50%. And for the put options, they start off in the money, so the probability that they will expire in the money is greater than 50%. So if you are an option buyer or seller, which is the ideal point, ideal delta for you? If you're an option buyer, buying options which are at the money or slightly out of the money, it has the best risk to reward. If you're an option seller, you want your options to expire out of the money. So the ideal spot, ideal delta for option sellers is less than 0.5. That is staying out of the money for both put options and call options. We've learned that delta also gives us the directional risk or the directional exposure. Stock always has a delta of 1. A call option with delta of 0.6 has 60% directional risk or a 60% directional exposure, whereas a call option with just a delta of 0.3 has a 30% directional risk or a 30% directional exposure. So for every 1 rupee increase or decrease in the stock price, a call option with delta of 0.6 increases by 60 paisa, whereas a call option of delta of 0.3 just increases by 30 paisa. So if you're an option buyer, you want to increase that directional risks because you're expecting the stock or the index to move in a certain direction, and that gives you greater profits. As an option seller, you want to reduce the directional risk. You don't want the stock or the underlying to move against you. So if you're an option buyer, the maximum delta is 1. So do we go and purchase an option with a delta of 1? The answer is no. As an option buyer, you need to find a balance between premium paid and the directional risk. Call options with delta, higher delta, higher absolute delta will command us significantly more premium, or you need to pay a lot of money to buy options which has got high delta. So you need to find the balance between the premium paid and the directional risk. Same thing with option sellers. If you go far out of the money, the directional risk is considerably reduced. However, the premium collected by selling these options is very, very minimal. So the return on investment is very low. So as an option seller, again, you need to find a balance between premium collected as well as the directional risk exposure. So the ideal delta value for an option buyer would be somewhere between 0.5 to 0.4. So that is close to at the money or slightly out of the money. Options are best for option buyers. The ideal delta value for option sellers is anywhere between 0.3 to 0.16. We have discussed that options at different strike prices have different deltas. Take for instance the call option. The call option, the at the money call option has a delta of positive 0.5. Deep in the money call option has a delta very close to 1. And far out of the money call option has a delta close to 0. Now the question arises, what happens to the delta when the price of the underlying changes? Let us evaluate that with an example. Let's assume Nifty is at 17,000. We're going to evaluate both the deltas of both the put option and the call option. As you are aware, at the money put option delta is minus 0.5 and at the money call option delta is 0.5. Let's assume Nifty moves from 17,000 to 17,500. So now at the money strike price has moved from 17,000 to 17,500. What happens to the delta? Delta also changes with the change in Nifty price. If you see, the 17,500 put option was in the money and had a delta of negative minus 0.5. Since now it is moved to at the money, the delta has now changed to minus 0.5. Similarly, for the 17,500 call option, it was out of the money previously and had a delta of 0.3. Now, since this call option has moved to at the money, the delta for this call option has changed to 0.5. We can now conclude that delta is dynamic and changes with the change in the price of the underlying. This change in delta is beautifully captured by another Greek called gamma, which we're going to evaluate in the next segment. So in summary, delta basically captures the rate of change of option pricing with respect to 1 rupee increase or decrease in the price of the underlying. It helps us understand the directional risk and the extent of that directional risk. It also gives us an idea of the probability of an option expiring in the money. As we've already seen, delta is dynamic and changes with the change in the price of the underlying, and this will be captured by another Greek called gamma, which we will evaluate in the next video. If you like what you watched, do subscribe to us. Till we see you next time, trade small, trade often, and more importantly, happy trading.